Welcome to the Gray Report. I'm your host, Spencer Gray, and this week we have shifting markets, shifting economic data, a ton of news from not only the Federal Reserve, but all kinds of new data points across the economy, but more importantly, shifting markets in commercial real estate and multifamily. Not only that, but on today's episode, we're going to be bringing in a member of the Gray Capital research team to talk about his new method for forecasting permits and starts. It's a novel approach that we've developed here at Gray Capital. It'll be really interesting to talk about how it's developed, what insights we can learn from it, and how we're going to be using it in the future here at Gray Capital and on the Gray Report. So stick around for John Chapman for that piece, but we've got other great articles and research reports. Matt Bosnagel joining me once again. Let's get into it. All right, welcome back to the Gray Report. Matt, let's just hop right into it.
Yep.
National Association of Realtors, NAR, June 2025, CRE Market Insights. We're breaking down some of the different asset classes inside of CRE, seeing how it's going. Give us a summary. It sounds like not everything's is responding the same in the market right now.
Yeah, so there's a little bit of shakiness outside of multifamily, but I think that this is a useful report. I like this as a reminder of how all the different sectors are performing. We've spent a lot of time looking at the apartment market versus the home buying market, and that's still really relevant. But then how does the apartment market stack up against office, industrial, retail, hotel? This is a decent report, and it's relying on CoStar data that we'll showcase here as well. So this is a very quick rundown, and people that want to dig in, they can access this full report on the show notes. But I'll just go quick flyby with quotes from NAR. Office has its 11th straight quarter of negative absorption numbers, and when we look at the graph here in a second, there's nothing pleasant about office. It doesn't really look like it's getting better. There are signs that it may not be getting as worse, but that's not the same as getting better, especially when you have such a big hole to dig out of the office is in. I see again, like, it's not getting worse, but it's not getting better. I don't see the light at the end of the tunnel. I just see more tunnel. And if you're used to living there, then that's great in that tunnel, but it's not. Nothing's essentially changing, and it doesn't look like it's going to change based on the projections from CoStar. So that's office. Retail is super interesting, I think, because
do you think, Matt? So just before we move on to office, I mean, do you see any chance of recovery? I mean, is there an opportunity in office for some office because it's so depressed? There's, obviously, if absorption is bad, and this is operations, but buying something pennies on the dollar, obviously there's a price maybe where it makes sense.
Yeah.
I mean, do you see that happening?
That could happen, but I don't know. Like, I'm struck by how much of a breaking point there hasn't been yet in office. Like the catastrophe that people had, like, it's not necessarily like subprime mortgage.
Happened.
Maybe it has, and like, it's just interesting to me that, like, there was such a huge remote working move, and people said, like, oh, this is catastrophe. And there was also some mutterings from commenters like, oh, they will prop it up. The fat cats in their office buildings, they'll make sure that they'll hang on to their money. That's why they're making everyone return to the office.
Whatever that means.
But I haven't seen I haven't seen like bankruptcies related to. I'm sure they're out there, but hasn't been the headline. They've said, office continues to be there's a lot of optimistic takes on the office market, like, oh, don't worry, it's not doing so bad. But there hasn't been like a cascading catastrophe that people are hinting at in the office. I don't know. There was a big tweet from the Moody's guy, and talking about the housing market as a red flare for the economy. Well, why hasn't there been a red flare from the office market? Because housing market, the prices are still growing. They're growing slowly.
I think housing is more systemically linked to the economy in many other ways than office.
Yeah.
I mean, home building is such a massive industry. In general, the price of homes is tied to Americans' wealth, of where office ownership is tied to a pretty small percentage of individuals. In general, if you think about like the net asset value of the net asset value of, all the office buildings, which I don't know off the top of my head,
yeah.
but it's less than all of the homes.
Yeah, and we're close enough to the apartment markets where I can kind of understand what the push pull is and where things are going. Whether or not we have the modeling that John is giving us on apartment supply. I will say though that I just don't know enough about office to know if there is a catastrophe, or maybe like they've kind of buttoned things up and it's just like what the worst is past.
I mean, there have been foreclosures.
Yeah.
I mean, there have been some high profile sales of office buildings that have sold for pennies on literally pennies on the dollar. I mean, the types of deals that multifamily investors would be drooling over.
Yeah.
I mean, ain't no deals like that for multifamily. It's because there's a strong bid on multifamily where there just isn't on office. Who's buying these buildings? The only way you're going to buy it is because you get it so cheap that it's like, with the one tenant that's in there, it cash flows. It's positive cash flow.
I drive by so often this office building, and even when there was CoStar people came and I mentioned it, because that's the first one that comes up on the CoStar like listings sometimes, and I see ads for it, and I'm like, well, if the price goes down, maybe I could live there.
Sure, why not?
huge
I do think there's an opportunity. Again, it's not like our strategy. So somebody out there.
Oh yeah.
So there's an opportunity not just in office, but also urban multifamily in some of these primary markets. We've talked about this before, but whether it's Chicago, New York, Los Angeles, San Francisco, markets that like make I know everyone's like cringing. They're cringing about the idea of investing in any of those markets.
Yeah.
These woke, liberal, whatever you want to call
Yeah.
But like rent control. There are good reasons good, strong, heavy, tall obstacles not to invest.
Yeah.
But because of that and many other reasons, the prices have come down. And if you would have told me a couple of years ago that like you can buy an apartment building in one of these primary markets for a cap rate for what you could buy something in Cincinnati, Ohio.
Yeah.
I'd say that the cap rate for the New York City or the Chicago or the Los Angeles should be significantly lower than your secondary market, in the Midwest. Now, there's growth prospects in the Midwest or the Sun Belt or wherever else. You don't have the regulatory issues in some of these cities. But man, I mean, you're just talking about location and interest and that like things go in cycles.
Yeah.
Well, again, just call me like simple, but it seems like we're at a trough of a cycle for these like hardcore urban primary markets that just nobody wants right now. But I can't imagine and maybe it's 10 years, maybe it's 15 years. I don't know. And again, I'm not pursuing this strategy. But I think they're going to come back. I mean, it's like you hear about, it's like the Chrysler Building or the Empire State Building, like going for sale, and it's like, oh, it's going to, but you probably got to put a lot of money into it. And I don't know, there's the trophy. There's always this illusion of the trophy asset, and it's like you're not going to. It's like, is it more of just like a legacy play? You're going to get an actual real return. But then also, if you go back through history, if you hear those times, those individuals that have that opportunity to buy those iconic landmarks for cheap because no one liked it at the time. And then, decades later or many decades later, you're telling the story of, your great grandfather and they're like, no one wanted this prime piece of real estate back in the day. I think some of those opportunities are out there right now.
If you're friends with enough government people, I think too. That's what makes me think of like, well, like I forget what story it was, but the CRE guy has a whole plan of revitalizing a whole region, and that's going to take a lot of handshakes with a lot of people in power.
But if you buy it, if you can buy it to where you can price all that in, of where it's like, all that can happen. They could like not let us do the project for years, but
Yeah,
we'll still come out all right.
And that's a good point. So office, okay. So back to kind of the context, larger context. Office, if I characterize it, it seems like there's something interesting that's about to happen, as much as it's like kind of plotted along, and the trends don't look very good. But I do think that there's like some opportunities, probably some really whatever the opposite of a good opportunity is, like
Bad opportunity.
Bad opportunity, some real big mistakes and some real big failures that could be off on the other side of it as well.
Yeah.
And okay, so moving to retail, I'm skipping multifamily because that's the foil. Retail properties, again, like absorption may have just turned negative, which is accelerating in its decline from the previous month. But that being said, the recent past of retail has been a lot more demand heavy than other sectors. So I feel there's a little bit of insulation and a little bit of room, I think, for retail performance in a larger context to still kind of come out of this. But that being said, the near term trends are downward for retail as well. Moving on to industrial. So here's the quote is, following a surge in 2022, the industrial sector is now facing a slowdown marked by oversupply and softening demand. From May 24 to May 25, net absorption fell 48% to a decade low of 67.7 million square feet. Now, I don't know enough to know how those millions stack up, but I know that a decade low is bad, and absorption falling 48% in a year is also not great. So that is a clear example of, and I thought that industrial was this stalwart that would always, that's always going to be doing great. It was the darling of the pandemic CRE market. I think all the cool people were in industrial, and I think there's more money in multifamily now and then, but this is a sign of softness in an industrial market that was once indomitable or couldn't be hurt. Moving on to hotel, hotel's kind of interesting, and that one is a little bit. I was looking up the graphs that we can show on CoStar right now, where we have a vacancy, absorption, and deliveries. Now, they didn't have that information as in the same terms as hotel, so it's a little bit of an outlier, but still, hotel, they say it remains steady. I think there's some shakiness in hotel, at least near term, because I've heard stuff about tourism going down.
I think we just need to just back up a little bit, because there is a big difference between when we're talking about hospitality properties, and we're talking about retail properties, and we're talking about industrial properties. I mean, that's like us talking about housing or real estate. There's so many different subclasses, and they're not all the same. I mean, they've broken the retail. I'm sorry, I'm going backwards, but again, going back to retail, there's a lot of different kinds of retail. A mall is different than a strip center. A gas station is different than a strip center. A grocery store anchored center is different than a random neighborhood center. The retail center with a nail salon, a little convenience store, and a restaurant that's in a dentist is a lot different than your mall, your B-class mall, your A-class mall. So it's much more bifurcated, I'd say. So it's hard to talk about retail in one context. It is interesting. I mean, there's this long trend of e-commerce obviously impacting a lot of the big box retailers, which is a whole other category. But it's like the nail salons are doing fine. If you've got a retail center with a nail salon and experience-related businesses, it's not something you can get off of Amazon. You're in it's a much different risk profile than a Target or again a Best Buy or a big box store.
I still think though, like there was a little bit of an expectation that this was a few years ago, kind of during the lockdown and during a pandemic, like retail's gonna suffer. It never really did as much as was anticipated.
No, because everyone wants to get out and do something. You still want to get out and do something. I mean, we're buying a lot online. At least according to looking at my house, like we get a lot of the Amazon boxes that don't seem to stop. And I'm like, what are we buying? And it's like, well, we're getting everyday items. It's like our, our shampoo's coming in the box also. It's like, okay, that's fine, I guess, because the shipping's free, I guess. But we still want to go out.
There's never it can't replace that for sure.
It's funny, sometimes it's like, oh, I don't have time to get this. I have to order it online. It would take me 24 whole hours. Then I'm like, I guess I could go to the store and get it.
But now you order it in the morning and it comes in the same day. I still am amazed. That still amazes me, these kind of same day orders. But but so moving to multifamily, which I kind of delayed it a little, but what they say about multifamily is by May 2025, the multifamily market is showing early signs of leveling off, supported by solid rental demand and robust absorption. National Association of Realtors is residential focused. Sometimes I think, well, maybe they're a little biased towards multifamily, but in their takes of all of these sectors, it did seem that multifamily was depicted and analyzed as a leader in a way that the other sectors, there was some, there were some caveats and some, things that may make them not as high performing as multifamily. I do want to show this comparison then, just kind of to close this out, of all these different sectors. So I just exported the graph from CoStar for multifamily. You can see it right here that vacancy according to CoStar, vacancy peaked at about Q4 2024, and since then it is steadily going down. Now that's multifamily, and if you scroll down, you can see for every single other sector, including office, which we see here, vacancy has not yet peaked. The peak is going to be projected to be the beginning of 2027. So it's still going up. The trend is not positive. The trend for multifamily is positive. Again, declining vacancy, increasing occupancy, but the trend in office is a steady increase in vacancy. And then moving to retail. Now, this is where I said retail had a really interesting story, because like a year ago, or maybe a year and a half ago, there was a couple year period of negative vacancy. Which is, I don't get it. What does that mean? What does negative vacancy mean?
It's occupancy. A lot of occupancy.
Yeah, like over occupied. Maybe two people are in, two store owners. Regardless of which of my ability to process it.
I think you're looking at the wrong side of the chart.
Oh yeah. I am. You're right. But
it's graphing, but it's measuring between.
Yeah, you are. Yeah,
and 5.6%. Okay. It's not negative.
They had a period of well below average vacancy, and that's what this is coming off of. So like the larger context is like, actually it's going to probably approach closer to its long-term average of vacancy, and it's not getting to like an above average place like office. So retail is probably normalizing is what I would say it is. And so it's not bad, but the general trend is a little bit worse for occupancy, a little bit, this increase for vacancy. Now, moving to industrial to kind of close this out for this comparison. Industrial, again, you can see in these numbers how low vacancy was during the peak of occupancy, and then how much demand there really was. But the general trend is upwards, and that's not going to hit a peak until mid 2026.
Yeah, so around like 2021, 2022, vacancy kind of was around the 4% range. CoStar's forecasting they can reach all the way up to 8% vacancy by 2026 before kind of correcting down a little bit.
I and John could probably support us here, is like, I would take the longer tail of these projections with a grain of salt. But the short term, like say next that also, 2 years,
because a lot they're just really reverting to like the mean or the average on a lot of these forecasts. But obviously there is some like movement. Again, you look at the retail forecast. There's a little bit of an S-curve dynamic of increasing vacancy and then declining.
And then if we pop back up to multifamily, just to provide this again, like this kind of reminder that things peaked in terms of vacancy. Things were at their worst near the end of last year, and it may not. Other data sources may differ. I think apartment list differs, but things are getting better for the multifamily market. And that's I think that's the commercial real estate projections that it gets a little shakier as you go off. But the only caveat I would say for multifamily is, even though it's going down, it's going to take several years for the vacancy numbers in multifamily to approach anything close to pre-pandemic averages. So it is kind of a weird moment here where vacancy is still high. There hasn't been like rent declines or anything, but it is a percentage point or two above what we were used to in 2019.
We're going to see, there have been some rent declines for sure. I think apartment list still has negative year over year rent growth for the nation. Obviously that's different depending on which region and which market you're in. But we built a lot of apartments, and they're not all going to be fully occupied. A lot of them are going to have been stabilized. They're 90% occupied, but they're not the 95% occupied everyone would like to see. And very few things are going to be, you're not going to get down to, 100% occupancy. Now, there were some markets during during COVID when, national vacancy was, according to this chart, was, at basically, vacancy was sub 5%. There were some markets that were 99% occupied, 1% vacancy.
Oh, this reminds me. I want to make this a thing. I want to keep the segment alive for good thing, bad thing. And before I leave here and John comes in, I want to say one good thing and one bad thing that I think about the multifamily industry. So a good thing, I think a larger look at apartment supply and demand trends like we've just looked here suggests that compared to other sectors, the apartment performance has begun this positive trajectory, which is several quarters earlier than all these other sectors. And the fact that it's this outlier here is, I think, a sign of positive momentum for multifamily, something that can give investors a little bit more confidence. The retail, industrial, those are big sectors, and multifamily is outperforming them. Bad, I think that potential housing market softness, sure, it may be limited to the single-family home market, but if home price growth continues to decline, and maybe goes negative, it's hard not to see some damage to multifamily performance. I think multifamily is somewhat insulated. We've been talking ad nauseum about how high home prices are making people continue to rent rather than be home buyers. But in the case of home prices going down, maybe more renters become home buyers. So this is a factor that's worth watching. And I don't think that apartment market is completely insulated. I think it's somewhat insulated. And part of my job and John's job, hopefully, will be trying to tease out the relationship between high home prices and high apartment demand. But at this moment, you can't count out the possibility, like, just guard yourself against that risk, I think. And so that's my bad thing and good thing. Nothing too bad, nothing too good.
I like how, Matt, for your bad thing is people obtaining home ownership. That's the bad thing.
Well, from the perspective of apartment renters. that's really good. Okay. All right, now I feel like I'm the bad thing. Yeah.
No, right. I think those are good, both good takes. The folks that are in that renters by choice category, the folks that could buy or they could rent, they have the money, the ability, the means to buy, but they're choosing to rent. It's a decent chunk of people out there. It's a smaller subset than there used to be. Yeah. Really what you're talking about is some of those renters by necessity now becoming renter by choice because all of a sudden now they can afford to buy that home. Yeah. And then are you going to take action on it? I think it's a relatively small cohort. And also what happens when prices are going down, sometimes people are like, yeah, I'm going to get in and buy. But usually a lot of times that doesn't happen for like another year or two. Yeah. Because everyone's scared.
Yeah. And one of the articles that we didn't have time to include during this episode of the Gray Report was an article, it's just interesting from Cotality, about the process of home buying and how home buyers get less confident because things are so complicated. There's hidden fees, there's insurance, there's mortgages, there's things that realtors know like the back of their hand. But home buyers are scared and they're hesitating, and that means they don't make that decision. And if there's ways that the apartment industry, whether from property management and leasing, can keep things less complicated and can maybe not charge the hidden fees or can build the trust that they really emphasized from this Cotality article, then maybe that's a way of emphasizing the benefits of apartment. But I still think that there is a big obstacle in homeownership where it's the biggest purchase you'll ever make in your life. And that's inherent. That's never going to really go away. Yeah. And so so there's a lot of stress there. What
do you think, Matt? Again, this is a little off topic. Well, that's John a bit. John is also because he's of the demographic. But do you think that, you have to kind of go off on the limb a little bit and take a leap of faith to buy a home? Yeah. As you said, it is complicated. Oh, yeah. You're making a major financial decision.
Their number
that could
one,
go wrong.
Their number one thing, because I was thinking like the biggest headache would be like, getting all the legal things or getting the number one worry, and it makes sense, is actually finding the home because the stakes are super high. If you pick the wrong one, then, oh man. Now I think people are picking the right apartment, right? They want to feel safe and they want the apartment to be nice.
But worst case is you just find something in a year.
Yeah, so the stakes are a little lower, and that's you can't simplify the process and take away those stakes.
My question is, Gen Z, Gen Alpha, certainly some of them do, without a doubt, but do enough of them have the risk-taking ability to make that jump? Do you know what I mean? That
Oh, yeah.
there's less risk taking because their parents have been doing everything. This whole idea of, you read the anxious generation. We've been like, helicopter parents to these kids. Maybe they need their parent to, maybe they just need their parent to go and hold their hand and buy their home for them, which I think is probably going on right now.
Yeah.
But if it's up to the kid, if it's up to the adult, I wonder if they have that ability to take the risk to buy a home.
Yeah.
Because also, unlike previous generations where home ownership was a key path to wealth building, now, everyone's so obsessed with the housing market getting ready to crash, even though it doesn't crash.
Yeah.
But everyone remembers the great financial crisis. And since then, everyone's been waiting to call the next big short. And everyone's getting ready to say, "Oh, well, I don't want to buy right now." Before the housing market just crashes. I told my brother to buy a house in 2018. He's like, "No." He's like, "What if the prices go down?" I'm like, "What if they do? What if they don't?" I don't know. You'll own a home.
Yeah.
Wait it out. Like pay your mortgage. I don't know. Don't move then.
I didn't even know. It was imperceptible, that moment of the shift between housing going down, and then all of us, you blink your eyes, and now housing prices are always going up. It was so.
But I had the same. It's like the post GFC mindset. I had the same thing again. Everyone's like waiting for the next recession, waiting for the next housing crisis. I remember I was like I was getting into stock trading and buying and trading options, and just to learn how it all worked than trying to actually make money, because I was more losing money and just learning about it. But I remember coming up with a strategy that I thought was like clever at the time. I'm just basically going to be like, I'm just going to short the market every day. Just because in my mind, it's like the market goes down more often than it goes up. But the opposite is true. It goes up more often times than it goes down. Otherwise, no one would ever invest in anything. In general, I don't know. That's why I'm a more optimistic person, net, rather than negative, because at the end of the more times than not, we, people, humanity, the economy, kind of figured things out. It might not always be pretty. There may be some pain along the way. In fact, the pain is necessary. But if you have a decent horizon, things will revert to the mean and work their way out. And that mean, on average, is rising over time. So, again, coming back to real estate and homes, I
think there's room for positive growth.
But, okay, coming back to apartments, does this mean more longer-term renters than home buyers? Because of that mentality.
That
they don't want to participate in the housing market.
I think that could be the case. Any build that we'll see any change in that behavior would be on the edges first. But it's going to be super interesting when what happens after the baby boomers are turning in or selling their homes or downsizing or something. May not ever happen, but I feel like that's a big inflection point, that as they get old and maybe they're aging in place, maybe they're not, but that's a lot of homes locked up by a lot of people. So we'll see what happens next.
Matt, from RealPage, multifamily momentum is shifting in top U.S. markets. What's new? What's going on?
So the momentum they're talking about here isn't necessarily rent growth momentum as much as apartment permitting. The permitting is going up. The nationally, it's about the same. It's maybe a little bit of an uptick, but in specific markets, it's gone up considerably. They have Dallas and Houston. These are huge markets, and permits have gone up in Dallas by 21.1% and in Houston by 29.3%. That's a big number, especially places like Dallas, where they're already building a ton of new apartments, and so that increase is really considerable. I'm very curious to see if this is going to continue or not, or if this is just if it's just like a 1 month thing. But like these are very big numbers in very big markets, and it suggests a lot of people think that there are going to be people wanting apartments. Otherwise, they wouldn't permit them. And I also want to point out Columbus in here as like kind of an outlier from the Midwest, that it's also seen a 25.4% change in the units permitted. This was something that I thought was like a little bit confusing. but it does make sense because we're still right now talking about how in 2026 there's going to be a jump in apartment demand because of the gap in apartment building. I mean, there was a lull in apartment building for the past couple of years, and maybe these market by market, these select markets are kind of hip to it, and they're like, oh, we want to capitalize this, be the kind of first mover in this space where there may be fewer apartments in the future, so people are looking forward to that.
Yeah, talking to real estate developers, it's not like there is absolutely the will to build more apartments. Developers want to build. The challenge has been securing the equity financing to be able to actually build it itself. It would appear that at least in some of these cases, that developers are able to secure at least enough of that equity financing.
They can convince like investors and other
They can get investors on board. But also, it's interesting. These are a lot of the same markets that are currently experiencing significant amount of oversupply right now, negative rent growth. Now they do have the population growth. So you can justify a little bit of like there's going to be a need for more apartments in these markets. Yeah. But you've already built a lot of apartments recently. One question I have for you, Matt, I guess how should we think about the percent change year over year? Because we've got some base effects that we're dealing with also because construction was so low last year, was it not?
I think that it's certainly a case, especially for some of the Sun Belt markets where there's a little bit of swings. But some of these places like Columbus specifically, it has had significant, like sustained, elevated deliveries, and they're coming down. But I just think it's really curious and really interesting that some of these what we would call oversupplied markets still have people getting excited about investing in building and making new apartments on top of the old oversupplied markets. I have to think that there's a reason for that, and it's not just like overhyped. Like people are confident, people are willing to put their money on it, and so I would take that as a credit to the longer term strength of the apartment market. Period. I don't think that it's foolish, especially if some of these developers are in they are building in a market that's is a little oversupplied, but it's a submarket that's doing well.
Well, that's what I was going to bring up is that when we just look at Houston, Pasadena, the Woodlands, that's a huge area. These are large MSAs, and as we know, granularity matters, nuance matters, and one whole market is neither good nor bad. You can have some markets that are generally rougher than others, but a lot of times, developers, especially in some of these markets, there was a high concentration of the new supply. And so there are other submarkets maybe didn't get that much new supply. And so you may have some positive rent growth that gets overshadowed. And so there could be some areas in Houston or Dallas and Austin and Atlanta that, are still undersupplied. People are still moving in there. And it's just those few areas that had a heavy concentration of new development that may see a little bit of a pause. But it's fascinating that we basically have the same culprits that have seen so much supply, they're going to get even more.
Yeah, it's like these markets are super sensitive to the larger changes, maybe that are slower. You see a little bit of a dull, of a dull increase when it comes to the national level, but in this you get this kind of extreme example, whether in like places like Orlando, which has had a 47.7 increase in permits.
Yeah, that's incredible. Now, I mean, the idea here is that they want to be delivering. Yeah. They all want to be the only ones, which clearly they're not going to be the only ones, delivering in an environment where there's no other new properties, no other new apartments being delivered. It doesn't look like anyone's going to be on their own, though. Looks like everyone's had the same idea.
Totally.
But you also have to put yourself in the developer's shoes. Let's say you're a developer that's based in, I don't know, let's say Orlando, Florida, and you develop in Orlando.
That's your business. You got to build.
That's your business.
Yeah.
Exactly. You have to. If you don't build, you're out of business essentially. And so you're looking around and saying, look, there's still some areas where we're going to need housing. Yeah. We still have a deficit of housing in this country and in their particular markets. And it's my business. So at some point, I need to start putting shovels in the ground. And I'm going to go back to my investors and try to convince them to invest in my deals. For the longest time, they're having a hard time doing that. But you're right. I mean, this is an obvious indicator
Mm-hmm.
that there is serious money
Yeah, the
that is
thesis is
backing
sound.
multifamily
Yeah.
recovery.
Yeah, and again, like it's serious money. These aren't fools, and so there is a profit motive for them to make sure that these are sound, and it's not just like chasing a dream. I think also that it's an example of how much diversity there is in not only apartment performance but in construction trends.
Yeah.
Things are moving different. The economies of these places are a lot different, and it seems like it's just getting worse and more varied in 2025. Maybe when things balance out, things will get the same. I kind of hope not, because I think it's really interesting to track out these differences and see how one individual market is moved by different things compared to another. It also illustrates the importance, I think. Here's a little teaser. We're bringing on John in just a moment. The importance of having an accurate forecast and being able to predict. Okay, so usually, you take permits and you jump and you think in 18 months there's going to be new apartments, but it's not always 18 months, and not every single permit turns into an actual like a
True.
built apartment.
Yeah.
And there's lots of other variables like construction costs and other economic variables and variables within what the starts and all this kind of stuff that is different for every market. And I was just talking to John, who will come here in just a moment, about he's running it at the national level, and he's like, to run this on an individual market level, it takes a lot of time. Maybe he's using these kind of machine learning techniques that do a lot of calculations really quickly, but it's still setting up each variable and making sure all the measurements are right. That takes time, and it's just because there's a lot of differences. I'd like for all these to be the same if it's for the ease of coming up with these graphs, but I don't think that they're going to be the same. And again, like I think it's just a little more interesting when we got more to track here on the Gray Report. So
Absolutely, yeah.
Yeah.
It's going to be. Yeah, I was just doing some quick back of the napkin math, Matt. I mean, this is almost could be anywhere between $30 and $40 billion worth of
Yeah.
investment. That's
Man.
debt and equity. But that's think about it. Close at least around 10 billion, if not more, of probably equity that would have to that would have to be deployed to build this many units. And this is just this is just the top 10 metros.
Yeah.
We're not talking about the rest of the country right now. That's a lot of capital that is betting on a strong multifamily recovery, because you wouldn't make those investments if you did not think that those markets were going to recover and they were going to experience positive rent growth in about 2 years or so.
Yeah. No, it's a very good point.
Fascinating. I think it's the perfect time, Matt. Let's bring on John Chapman. He was our intern for this summer, but really he's kind of like our research scientist. Really excited to have him. Let's bring John on. All right, now on this segment of the Gray Report, a special guest, John Chapman, who is the summer intern here at Gray Capital, Ohio University student, but really has been kind of acting as our chief data scientist here at Gray Capital, because we don't have any other data scientists primarily. But John, you've kind of stepped into a little bit different role than some of our past interns have, which a lot of times, helping out various aspects of the company, whether that's in property management or accounting or investor relations or asset management. You focused a little bit more on really some of the research side, because at Gray Capital, we do publish regular research reports, analysis. A lot of times we're aggregating data and analysis elsewhere, consolidating it, and then providing our own analysis on top of it and putting these research briefs together. Some of the work that you've been doing through some of what you've been learning in school and then just doing in your own time has allowed you and us to dive a little bit deeper with some areas of statistical analysis. So first, just maybe can you give us just a little bit about your background, and then just a little bit of generally what you've been doing here at Gray Capital this summer before we get into what your research is showing.
So I am currently finishing up a bachelor's in business economics at The Ohio State University. Just got a couple semesters left on that. I have a real interest in sort of the data and numbers side of things. I've always loved looking at a big spreadsheet. In regards to what I have been doing at Gray Capital this summer, it's been a lot of firstly getting acclimated to the kind of economic environment that multifamily inhabits. It's a little different than, I guess, like what someone might be doing if they're going into, something related to like stocks or finance. It's definitely has its own kind of unique sphere. With that being said, definitely spent the first part of the summer kind of getting acclimated to what that environment looks like, and then putting into practice some of the things that I've learned at school and on my own in regards to statistical analysis, seeing what's the correlation between these two things. Is one, indicator a good indicator of another thing? How well does rent growth predict what future supply is going to look like? And so going on into the summer, I started to take a special focus on, can we predict or can we forecast what certain specific markets are going to look like for the sake of the business, but also just for the sake of getting more information out there. It can never hurt to have too many forecasts out in the world. And so getting into that, we started with a project that I worked on for a good bit of the summer, probably going into the start of June or so, where we took some very key economic indicators, variables, such as rent growth, growth, supply growth, and vacancy, and plugged them into some more simple kind of forecasting models to say, what does the supply growth and rent growth in Indianapolis or in Columbus look like going into 2026? Just starting out very simple to get an idea. And we released that report, if I'm not mistaken, just a few weeks ago now.
Yeah, I think it's called Predicting the Future of Multifamily. And I'm curious to ask you about that report. And you can go to graycapitalllc.com right now and download a version of that report. Did anything surprise you, I guess, in terms of like which variables were more important, which were statistically significant, which weren't? Anything, I guess, surprise you from when you started that process to when you finished it?
Yeah, definitely. Historically, when talking about supply growth, for instance, or rent growth, something that has always been, I guess, closely looked at is like, what's the job growth looking like? But then you look at areas like Austin, for instance, which are seeing great job growth, but they're seeing negative rent growth. So we said, okay, so what's the other story going on here that isn't being told? And we looked into variables like vacancy, for instance, which showed that, despite the job growth still being great, vacancy was continuing to rise because the supply growth was outpacing the demand for it. So certainly, I was surprised to see the alternate side of the story that I guess wasn't really being talked about as much. I talked to quite a few experts in regards to, what variables did they historically use to predict supply and rent growth and such. And definitely there was kind of this unknown kind of horizon getting out of COVID to say, how are we going to predict rent growth and such in this new economic landscape. So definitely it was a surprise getting to work with those variables and kind of discover on my own what that kind of new story looked like getting out of COVID.
What are some of the indicators, not, going to every single piece of your model, but what are some of the indicators, I guess, that you would say is primary of forecasting rent growth?
So definitely job growth is still very important. There's definitely markets that are dominated by lots of people moving in. And sometimes that doesn't even necessarily appear in the job growth data. A good example is some cities in Florida, which despite not having huge job growth are still seeing increased rent growth because they have lots of people moving in to retire. Yeah. Examples like that. Some more kind of sub-market specific examples. Vacancies, like I mentioned before, I think a really important one. I wouldn't say necessarily overlooked, but maybe people are starting to consider that it has maybe a little bit more of an effect than it previously did. You have markets that are seeing, rather record low vacancies, and they're seeing great rent growth. A good example is Kansas City, for instance. Not crazy low vacancies, especially in consideration to some other markets like Philadelphia, which is seeing very, very low vacancies. But like Kansas City, for instance, a decently low vacancy combined with a decently high job growth has led to just a really, really strong rent growth record. So I would say vacancy is one of those where if the gap is there, then it indicates that not enough people are moving in to sustain a good enough rent growth. Whereas people were traditionally kind of relying on the job growth in of itself to tell that story. We're kind of maybe missing the second piece of it. Definitely some other indicators would be things like just population growth in general, especially when it comes to larger kind of apartments, 2-bedroom, 3-bedroom, people moving in with families, stuff that isn't necessarily reflected by job growth data, just because more people might be moving in than the job growth is indicating.
And so so you've got all these variables. How do you determine like the weighting of all these variables? What's like more impactful and significant, statistically significant?
Yeah, so a lot of it can honestly be discovered just through doing some statistical testing. The easiest way, just for example, is a regression. We plot all the data out and we run a regression in a statistical software, and it says, all right, here's what if you were to take 100% of this rent growth picture, here's what percentage that job growth contributes to or vacancy contributes to, and depending on what kind of model you're using, that weighting will vary, especially if it's something like a time series where you're using data from each quarter to kind of build a story over time. The weighting can certainly change, as we've seen coming out of COVID.
But different markets also require a little bit different weighting. Also, you discovered.
Yeah, right? Definitely. Different markets kind of are telling different stories. I say almost they're kind of in a different phase of their life, going between undersupply to really strong rent growth, but growing supply to finally the supply overtaking that job growth. And as a result, the rent growth starting to decrease again. I would describe it to be pretty similar to kind of like a business cycle where you have, booms and busts, and it's always kind of flowing like a wave going up and down.
Got it. Okay, so focusing on rent growth, looking at some supply forecasting. Then you started looking at starts and permits, and not to fast forward too far ahead, but you were able to come up with a new way of attempting to predict the amount of starts, and it's by looking at the ratio, by forecasting the ratio between permits and starts, rather than just trying to forecast like the actual just discrete numbers themselves. Did I summarize that correctly?
Yeah. So basically, this came out of, I don't know if you want to go ahead and talk about the kind of how this came about.
Go for it.
But this basically came out of a conversation that I had with chief economist at RealPage, Carl Whitaker. I had a great conversation with him, and it generated some, questions that were lingering in my mind. He had talked about, forecasting permits, forecasting starts, and then kind of settling into a ratio. And I'd kind of thought in my head at the time, without maybe a proper justification why, but later on discovering it, was that, why not just forecast the ratio itself? And so I looked into it and I kind of thought about it some more, and I came to the justification that and it has been backed up by some data and analysis I've done, that just forecasting the starts without forecasting the ratio, you're sort of baking that ratio in, but the general kind of assumption that you're making is that the level of starts is going to be at least semi-independent of the level of permits, in the sense of it doesn't take into account the economic variables during that quarter where they decide to turn this permit into a start. For instance, you could have, let's say you have 80,000 permits from however many quarters ago.
Yeah.
And you go on now into the present. Previous models would say, okay, here is the 80,000 permits. We're going to give it an arbitrary lag of time to say this is how many quarters it's going to take to turn into a start. We are going to take the economic conditions, and then we're going to just plug it all in and say, okay, based on the economic conditions, based on the permits, here is how many starts. And so it's kind of assuming that a ratio is there, but not forecasting one directly. And so the reason that I decided on to try to look into forecasting the ratio directly was under the logic that, okay, we know the amount of permits. Instead of predicting what level of starts there might be, let's hold level of permits constant and just predict what percent of permits, regardless of how many permits they are in this current quarter, are going to turn into starts themselves. So previously it was very dependent on the level of permits, whereas now you could conceivably have any level of permits and still have a similar outcome of the ratio, and it would say this X percent of permits, regardless of the level of permits, is going to turn into starts.
And so you're looking more at macroeconomic factors to determine that ratio.
Yes.
Which economic factors are you looking at, and how do you choose those?
Yeah, so I mean, there's a million different variables that you could use to predict it. Some are used more commonly than others. Definitely, rent growth is one. Job growth, obviously, previous level of supply and permits are baked in a little bit. Although I will say that when I did some testing, I found that going into some lagged periods, the percentage that the current level of permits depends on the previous level of permits is actually not as high as people might think. We were seeing less than 10% of permits from this quarter were dependent on the level of permits from last quarter. So definitely diving into some of those more variables that are separated from the permits themselves. More examples are 30-year mortgages, 10-year treasury rates, pretty common stuff. But then looking into some more specific stuff as well, like construction cost indexes, lumber cost the lumber cost index specifically was one that I felt was very interesting because many of these multifamily constructions are we do a floor of concrete and then 3 or 4 floors of lumber. So with lumber being a pretty important component of this, tracking, what is the price? Is there significant import prices coming? I know we import a lot of lumber from Canada. Is there a lot of import price that's putting pressure on the cost of construction? Just taking a look at all of that to see, when people decide to permit, they think it's economically viable in the future to build that said thing. But then when it comes to that future point, is it still economically viable to do so?
Have you gone back to see how the ratio has changed over time? Do you have enough data to be able to go back to see, I guess, the variability of the ratio itself?
Yeah. So the ratio has definitely been something that has fluctuated a lot, sometimes just due to noise and arbitrariness. I have data going as far back as like the 1960s. I would say maybe just like to highlight specifically what a good example would be, like 2014 to 2025 is kind of a good example where in periods of economic recovery, where inflation isn't crazy, the ratio is generally closer to 100%. You're getting, high 80s.
What's permitted is being built eventually.
And especially if you are increasing permits from one quarter to the next, typically the ratio is going to stay close to that 100%. Whereas if the permits decrease the next quarter, you'll probably see a little bit of a drop on the ratio. A good example is once COVID kind of hit, inflation happened to a lot of things. You saw a real widening of the ratio, getting sometimes even as low as into the 60%, where it's just, people set up permits maybe even before COVID, and then COVID hit, things got really crazy. And then we said, all right, it's no longer financially feasible to build. But what was interesting is that even then during COVID, post COVID, there was a very large amount of, permits, and there was a large amount of starts as well. It's just the percent of permits that turned into starts just was not like it had been prior to COVID.
So now, how about today, when not only do we have all of those economic indicators, we have it's like a noisy environment, a lot of uncertainty, but then also, there's, and we talk about this in the report every week, there's a lack of equity financing for new developments, and it's where you could see, I could imagine that the ratio would be off, less starts than are actually permitted. Has that has the noise helped kind of, I guess, develop the model, or is it more challenging to make use of it?
Um, I would say generally the noise has made it more challenging, just in the sense of like it's not as predictable as you would want it to be. For instance, permits and starts are way up this quarter. After we've seen quarter after quarter of decline. Last quarter we were in the 84,000, I believe it was, for starts. Now this quarter we're seeing 100,000 for the quarter.
We were just Matt and I were just talking. A new RealPage report shows that a lot of markets that are already oversupplied are permitting tens of thousands of units.
Yeah, and so there definitely has been a reversal, and it definitely it makes you wonder: is that reversal a trend or is it noise? And the issue with anybody doing any forecasting is that you have to, I wouldn't say necessarily make some assumptions, but you just have to you let the model do its thing, and it can say some really crazy things just based on that noise. For instance, if the model thinks that jump is a trend, then it's going to forecast that there's going to be a huge increase in permits just because it would expect it to keep going up. Yeah. Or if it thinks it's noise, then maybe the forecast is going to say that it's going to go down. Ultimately, there is still room for an economist to say, what do we believe is realistic for this situation? Do we believe that it's realistic that it's going to go up? If not, do we need to look at examining or tweaking the model? Or if we do believe it's realistic, then is there precedent for that happening?
We've heard from some economists just on that, the recent kind of surge in new permits, that maybe it's more noise than real trend. Do you have an opinion one way or the other, or kind of an explanation of why we've seen a tick up?
Yeah, I think definitely they're if I were to say between noise and trend, I would be inclined to say, sure, we could have both, although I would say maybe it's more noise than trend. If I had to guess, I would say we would probably see a decline, not a substantial decline, but a decline nonetheless in the next couple quarters back into a more flat area, probably around 90,000 to 100,000 starts per quarter, if not a little bit lower.
I think you were saying yesterday, most things don't usually go in an absolute straight line.
Yeah.
They can be declining and then a little bit of a surge up, and maybe this was early positive sentiment, maybe of tariffs being resolved, maybe rates going down, and so a bunch of decisions were made. Equity was deployed in some of these developments, but it sounds like we're going to need to get another quarter of data, or at least a couple more months.
Yeah, I would say definitely. A quarter or two. When we're thinking about permits, depending on how long it takes for a permit to go into a start, you're looking at multiple quarters even. I would think about it sort of like generations. If a generation has a larger than normal set of births, for instance, then the generation or a couple generations after them is going to also have a larger than normal set of births. It's kind of a jump and then a settling again, and then another maybe smaller jump. Yeah. So time will tell on how many of these permits turn into starts, although it's very based on how many starts we've already had this quarter. It could be assumed that probably a decent amount of them will, and that might spike up the data a little more.
So, what is the model showing? Have you taken a look at with this new data of how many permits? How many permits are going to turn into starts? Do you have an idea?
Yeah. So I can't speak too specifically on the proper forecasting, just because there is some more tuning that needs to be done to the model. I can say,
we want the numbers. We want it all now. But John, what do we invest in?
So I can say, and I just want to make sure I have the graph that I made in front of me. I can say that probably going into next quarter, we will safely see a small decline in starts. Like I said, probably around 90,000. Although I would say that the quarters after that, going into 2026 Q3 or Q4, you could probably see it go up to as high as 130,000 or so.
And so we haven't mentioned that, I guess said this yet, but what's interesting about, I guess, this method and why we're talking about it is that, from my understanding, my research, this is 37. This method of predicting starts by determining the ratio between starts and permits is 37% more accurate than just trying to predict the starts themselves of any known method that we use today.
Yeah. So basically, what I did was I trained the model, and then I had it forecast just starts directly. I had it forecast the ratio, and I had it forecast the level of permits. Then what I did was I took the level of starts, and I took the level of starts from permits. So I took the permit level, multiplied it by the ratio, and then I got a level of starts from there, compared them to historical data from 2014 to the most recent data in Q2 2025. And what I found was that the data or the start level from using the ratio was about 30% more accurate. There's been more tuning going on, just more adjustment, getting the more recent Q2 data, making, changes to just tweaking the model to make it as accurate and honest as it can be. But it has repeatedly settled into about a 30% more accurate in regards to error against historical data. That comes from the mean average percentage error, which is basically you just have all of the errors. So, you have the actual amount of starts, you have your predicted amount of starts, the percentage difference between the two. You sum all those up and you take the average of them, and it says, on average, this is how far away we were from reality. Yeah. Taking those two, I found that with direct starts and the starts to ratio, it's settled into about 30% more accurate in regards to the predictions compared to reality.
Were you surprised that it was that much more accurate?
Yes, honestly, I was. Not just based on the 30% itself, but there's a statistical test called the Diebold-Mariano test that you can use to test two different models against reality to see how accurate their predictions are, to say, is this model only slightly better? Is it just about equivalent, or is it significantly better? You're looking for a percentage value of 5 or less, meaning in all instances of this model, if the result from the test is 5 or less, it means that in every instance or 95% of instances where this model is run, it performs better than the model that is compared against. In this instance, it would be saying that the model using the ratio, it would be better than the model that just directly forecasts starts. And so ran that test, and what was interesting is that we got a percentage value of 0.1 or 0.00111, which is 0.11%. Basically meaning that there is very strong statistical evidence based on the testing that has been done so far in the data set that I'm working with to suggest that the model is not only better, but statistically significantly better, in the sense that if you were to run the model 99.9% of times, it would outperform the historical model just projecting and predicting starts directly.
Wow, that's incredible. Do you think, is there not, how do I say this? I mean, there's a lot of good economists, that are in this industry looking at, maybe multifamily isn't as large as as the whole housing industry. I'm always surprised though. We've talked about this. For as large as housing is, it's more than 30% of making up of CPI. It's a huge percentage of GDP. There's all those ancillary industries. There's not always the attention paid from economists compared to other industries or trying to just do other types of macroeconomic forecasting. Are you surprised, I guess, with maybe the lack of research and the fact that, you've been here looking at housing now for this summer, right? That no one else has started looking at this method in the past? I was a little surprised. Not that I'm not a statistician. I'm not an economist. I often need ask you to explain it to me, like I'm a 5-year-old. But I guess I don't know. You were surprised that no one has taken this method before,
Yeah.
or is it that is the technology, or are the processes you're using are new that haven't been around for a while? Or?
So, at least in the regards to like this method not being used before, um, I did I did perform a like literature review on what had been done, and a lot of it had just been let's forecast starts directly. Um, I can think of a couple reasons. One is just there might not be a lot of people doing this, but the other option can also be that more testing does need to be done to ensure that in all instances in data sets does this model outperform forecasting starts directly. The margin of error is pretty good on this, but it could certainly be better in the sense of what the next step of this is going to be is let's take what data sets are other companies using to predict starts. I don't necessarily mean like what model they're using, but what data set are they using. If we were to plug in their data set, because they might have some variables that might work a little better than what I selected. You can there's a million different variables that you could use to predict starts, and then the job of the economist is to say which variables do we feel are going to represent the story closely enough. So the challenge or the job going into the future, what needs to be done next is taking this list of variables that other groups have historically used, plugging them into the data and saying, does the model still hold up? At least thus far, from what I've seen, it has. But more testing can always be done. More validation can always be done. In regards to it not being used, so to, I guess, kind of sum that up in regards to why it hasn't really been done before, it could be said that the models that have been used historically probably work pretty well. And so with something that's ever fluctuating, like, the permits and starts where, one quarter or for the past 4 quarters, you've been declining permits and starts, and then all of a sudden you have a big jump. Many people can just say, this works good enough. We have a, 7% margin of error. We're going to take that. We're going to say, for our purposes, it's good. Yeah. For me, I just want to always believe that things can be just maybe even slightly better. Yeah. And so it's been exciting getting to work on all this. And the hope is to keep testing it with different variables to say, is this stacking up? Is there instances where it's not as good? What might cause those instances? To truly just be, as honest about everything as possible. I'm not trying to push anything saying like, oh, this is something revolutionary. It's more efficient. But I also want to make sure that it is, as rigorous and honest as possible. Yeah. Don't want to ever, sell something.
Still relatively early stages, right? I mean, you came up with this relatively recently. You've been doing, a lot of work on it. Validation, more validation needs to be done, more testing. And we're going to continue to do that. But but congratulations on working on this, coming up with it. It's really exciting. How do you see this being used beyond just kind of predicting, I guess, what starts are going to look like? How can you imagine groups like Gray Capital or other groups, developers, kind of economists using this information?
Yeah, so definitely, if you can get a good pulse on where starts and permits are heading, then you could definitely get a kind of good pulse on what your future, like, for instance, what future vacancy is, assuming you have a decently good idea about where the job market is heading. For instance, we can know that, like, let's say a factory is opening, or like an Intel chip plant east of Columbus. We know that that's going to pull in a lot of people. What we don't know is, what's that going to do to rent growth? What's that going to do to vacancy? But if we can have a better pulse on what are our permits going to look like, what are our starts going to look like, to a degree of just maybe even 30% more accuracy, then we can say, all right, based on that, we can feed that in. We can feed the job growth in. We can feed a few other variables in and say, based on that, we think we might have a even more accurate idea on where rent growth or where vacancy is headed into the future.
Yeah, that's great. Just I find it interesting. Housing we talked about, sometimes just there isn't as much data, and real estate investing historically has been there's been a lot of intuition and a lot of back of the napkin analysis, and only until recently has it gotten much more sophisticated. Kind of the institutionalization of real estate and real estate investing, and I think we're still kind of at somewhat early innings of that process. But having this level of analysis and detail, I think, is really useful. Not just again for real estate investors and companies that are doing what Great Capital are doing, but also again economists and anyone who's trying to understand again the direction of travel for the economy by looking from a market by market standpoint and then extrapolating out. But it could be really interesting.
Yeah, definitely. I think there definitely is, especially in a sector like this, a very important place still for that, at least in my very limited experience, for that kind of back of the hand or back of the napkin kind of analysis.
Yeah.
And the reason being is that, for instance, if machine learning, like what we're doing for this permits and starts and ratio forecasting, if machine learning was the end all be all, then everybody would be making millions of dollars on the stock market, for instance.
Perfect, right?
Like if it could perfectly predict the future, then we'd all be set. But it still has its own issues. It still has its own limitation. No matter what, even people will say AI is going to take a lot of jobs or whatever. There is still going to have to be room, or there still will be room, especially in a market like this, for people who have expert knowledge on like a specific geographic location. If somebody knows a lot about the Columbus submarket or the Indianapolis submarket, that is oftentimes that knowledge on the market is going to, if not outperform, then go along very well with what is being predicted by the models. Yeah. Introducing that individual submarket knowledge is still going to be into the future a very important component of getting a pulse on what the market will look like in the future.
Yeah. No, I think that makes sense. I think there will always be room for both some empirical evidence, but then also a little bit of just experience, kind of gut reaction, feeling, and just kind of just knowing information that might not be inside some of those models. Also, so I guess what's next in terms of of what's like your next question related to housing statistical analysis? What's that next question that's kind of been tumbling around, and the next thing you want to kind of look into if you have something?
Yeah, I mean, aside from just like validating this model and checking it with other people's variables, I would definitely like to look into better ways of predicting what the demand side of things is going to look like. I heard some very interesting things about school enrollment, for instance, to get a better pulse on, just general population coming in aside from just purely job growth. It's one thing for jobs to be growing, but are these people moving in to move into a 1-bedroom apartment, or are they moving in to move into a 3-bedroom apartment with a family? Yeah. Definitely getting a better pulse on what the demand side things look like. Like I mentioned earlier, like even like there's Florida submarkets where the job growth just isn't there, but the consumer spending is, because everybody who's moving in is, settling down to retire. They've got quite a bit, saved up that they can just, spend on whatever aside from like rent and everything. And so exploring how the different facets of different local economies can be used to predict that demand in a way that maybe job growth just by itself doesn't reflect.
Yeah, no, it makes sense. I think a lot of people are learning right now that, if you look at just one variable or just a set of variables, they can be misleading. It doesn't mean that if jobs are coming to a market, that doesn't necessarily mean it's a bad thing, but it's not necessarily the whole picture. Because like you said, there's markets with strong population growth, strong job growth, but they have negative rent growth. And then some markets that maybe don't have that great of job growth, but the rent growth is positive because there's enough people moving in, retiring for different reasons. So there's a lot of nuance, a lot of subtlety that easily is lost when you zoom out. But it's fascinating.
Yeah, definitely. I think Columbus is a great example. I worked. Columbus was. I love talking about it. It's where I'm from nearby, but also it's a very interesting kind of market because in the past few years, it's seen a lot of job growth come in. Yet rent growth as of this quarter is actually a lot lower than it's been recently. And so looking into why is that the case? Oh, vacancies are on the rise. Supply growth is great, and rent growth still is positive.
Would you have thought rent growth was so, maybe not negative, but like if you hadn't been here working here this summer, I'm just curious of what your perception of rent growth would have been.
Had I not worked here this summer, I honestly probably would have thought rent growth in Columbus was insane. And the reason why was because the area where I live is close by to where they're building the big Intel plant.
Yeah.
And seeing people getting out of high school, moving into apartments nearby there, you were looking at $300 a month jump in rent from just a year ago. Just insane jumps. And these aren't necessarily like the fanciest buildings either. These are buildings that were built in the 80s, built in the
luxury
70s.
apartment. Now all of a sudden, luxury apartments with new granite countertops, and we've seen that before.
I mean, I lived east of where the Intel plant was being built, but the same amount of the same mileage to the west, you got Columbus, and so like I would assumed it would have been very similar. But then you look kind of more into the construction side of things. You see, okay, well, I mean, turns out Columbus has a decent amount of room, especially on the east side, near the New Albany area, near the Pataskla area, to keep building out, to keep building multifamily kind of places, and they've definitely built a lot of that as lots of people have moved in, to the extent of outpacing the job growth that's coming in. And if I could just speak on it again, or speak on it just a little bit longer, about my, I guess, kind of personal theory, and to give credence to the idea of like individual economic conditions.
This is combining the real world experience, the gut reaction, to also the the empirical data.
Yeah.
So please.
If I were to give, I guess, my own thought about why that's the case is, the Intel plant has already been delayed for quite a bit. It's supposed to open, delayed. Supposed to open, delayed. And so you have people moving in and that creates the job growth, that creates the population growth, with the expectation that those jobs are going to be there. Now we're a couple of years down the line, the jobs still aren't there yet. Sure, the construction jobs are. Sure, maybe there's kind of some secondary jobs that are popping up, but like, let's say the Intel plant specifically, the jobs aren't there. And so people are maybe there's more people who are planning on moving in, and they're saying, okay, we're holding off. Or maybe the wave has already gotten there where everybody who is going to move in, or a large majority of them have, and the developers kind of expected that wave would be a little bit bigger.
Yeah. Well, then there can be the pullback, because then is this ever actually going to happen? And we had such high hopes, they didn't materialize, and so now we kind of have the opposite reaction.
And I think definitely there is a desire for local government, for people in the area to, I wouldn't say necessarily oversell the idea, but they're talking about billions of dollars of economic development. Sure, there are billions of dollars of economic development. What is the actual number of jobs that's turning into? Yeah. I mean, the data itself is pretty good to say, okay, there's a good amount of jobs being created, but does that amount of jobs actually translate into billions of dollars if it was all, factory versus, lots of machinery doing the manufacturing itself? And so just that turning into an actual concrete number of jobs, it could have been that the developers and the local government sort of overestimated.
No, a big public-private partnership that, kind of oversold things a little bit. Never had that before. Up in Wisconsin, I know they've got the Foxconn plant. I think they're still waiting for those jobs to come online. That was, I think, however many, a decade plus. But it makes the headlines when you throw $1 billion or several $1 billion behind something and thousands of jobs. And because people are, they're selling it. They're selling it to the state because there's incentives that are involved, and they're trying to bring home a win for the state. But how that actually materializes isn't as always as clear, and it certainly doesn't happen as quick as everybody wants it to. Like right after that announcement. I've just got a couple more questions for you, not necessarily related to the work you've been doing, but because you're a man, and we were just having a conversation talking about home buyers, renters, and Gen Z, Gen Alpha. You're Gen Z, right? You're Gen Z. So, and you never want to paint one generation with a broad brush. I mean, millennials. I'm a millennial, and so we get put into a certain category of like avocado toast memes or whatever disparaging meme you come up with. Gen Z. There's the same type. I find that you don't necessarily toe the line of all the Gen Z kind of memes or stereotypes, but you're an RA in college, so you're experiencing and you're interacting with a lot of people your age. Question is on buying a home. There's an amount of risk tolerance that's involved to go out and buy a house. You have the money to do it. You have to take a little bit of leap of faith. Say, I'm going to put that down payment down. I'm going to lock in. It seems like there is this idea of like the housing market could crash at any time. The question is, do you think Gen Z is going to have the risk tolerance to buy homes when if they can afford it? Do they have the risk tolerance to do it, or are they going to prefer to continue to rent?
I think generally, let's assume for a second there isn't a crash.
Yeah.
Many of the people who are going to be able to afford a home at, let's say $300,000 will probably also be able to afford that home if it's at $325,000. In terms of elasticity, meaning people being willing to buy at a given price, it seems like in regards to Gen Z, the people who are going to be able to afford it probably will, assuming the price doesn't get too insanely high, assuming there isn't a crash. I would say in terms of risk tolerance, definitely that is going to be a very small segment of Gen Z. I mean, you're looking at wages coming in of Gen Z coming out of college for graduating class of 2021, 2022, all the way up now. We're soon when I graduate in 2026, and looking at like employment, looking at wage figures. There are some people, let's say computer engineers working with AI.
Yeah.
People working in finance, people working in accounting, different sectors. Sure, there are people who are making great money, but it seems to be a lot of the case more of the exception rather than the norm. So if we look at how that would translate to the housing market in regards to risk tolerance, I think there's a lot of Gen Z who are under the vibe that they are going to hold their breath and hope that a housing crash happens.
Like believe it. Yeah. So believe it when I see it. And the only way I'm going to be able to own a house is if the housing market crashes and I can get in at that point.
Yeah. I mean, I don't think that's necessarily a irrational thing to do. It's just housing prices can only go so high before they get a certain amount of, standard deviations over what would be an expected rate of growth. The stock market's in a very similar place where it's, reached now over 2 standard deviations in a kind of a similar place where it was pre-dot-com bubble crash, pre-other financial crashes. And so I'm not going to make any claims about whether a housing market crash
I was going to say, it sounds like you're ready to make a claim.
But certainly you see a lot of Gen Z hearing the news, seeing content online, on TikTok, on Instagram, saying about how unaffordable houses are. And so I think in many people's minds, they say, well, I can't afford one anyways, so I'm just going to rent for now and let's see what happens.
Got it. Yeah. Wait for the crash. Do you think that my assessment of Gen Z being maybe less risk tolerant is correct or incorrect?
From what I know, I won't claim to be an expert on like demographic stuff. From what I know, though, more Gen Z seem to be taking interest in stuff like investing, which typically takes a little bit more risk tolerance than just putting in your money in a high yield savings account or just leaving it in your checking account. Yeah. Lots of Gen Z are looking into investing, into crypto, into different ways to maximize their assets while they are unable to build equity in other ways, like owning a home.
Is that because it's fun? Is it because you see other, it's like FOMO, you see someone else doing it, or is it because I have to do this? My only other option is I'm going to, work at retail. I'm going to be a wage slave forever. And the only way out of this is I need to make some investments and, swing for the fences and hit one. What do I have to lose?
I think there definitely has been two different narratives, specifically in regards to what is being consumed online. The first narrative is you can make millions of dollars on the stock market. You just got to buy into this crypto coin, or you just got to buy in to this stock, and it's somehow going to explode 100% overnight. I think there definitely is that vibe, if I just say, going on online, where there's lots of kind of influencers saying, you can be rich like me, you can have this Lamborghini, you can be able to afford everything that you can't because the economy is in a struggling place. Selling kind of selling a sense of hope more than anything else that these people or that these Gen Z will be able to afford what is becoming very unaffordable. And then there is the secondary set of media that is being consumed, which is that, we can't afford a house. We're going to have to rent. How can we make the best of a bad situation? They're definitely, I think all in all, despite the fact that there is lots of, I would say, get rich quick kind of information being posted online, on the whole, financial literacy has been on the rise.
I think that is definitely a benefit from all of the, even though the finance the gurus out there, which some of them are predatory, some of them, there's a lot of grifting going on for sure. But if there's also a lot of people being aware and are getting an interest in financing and investing, and whether it was a meme coin that made someone aware of what finances are and what securities are, and it sparked that interest and got them into it. It kind of doesn't matter what the entry point is. The fact we're going from almost no level of financial, education to at least being aware, and then the opportunity to go down a road and take a deep dive into personal finance, investing, because all that information is out there, whether it's free on YouTube or, you go to the library and read a book, or you buy, somebody's course that may be legitimate or maybe not. But that is interesting. And just the financial, regardless of what you think about Gen Zs. And I think millennials probably split in half. Some are too far gone. Some I think probably are more interested because they have to figure it out. But really kind of your generation and then the next generation also are kind of growing up being immersed in this environment. So I think that you would think that would be a net positive for society. And then even longer term, we're talking about generations, think about how whether we manage our businesses or our institutions, or even the government, are we, this is the optimist in me. It's do we have hope down in the future that we're going to have, generation of leaders that are more financially aware would be a benefit to us all.
Yeah. I think it definitely depends on, I think definitely the media that is being produced is a result or is a pulse on the greater state of the economy, for instance. A lot of this kind of stuff is being produced because, or the conditions in which this media is being produced are a result of housing being unaffordable. Lots of different consumer staples being unaffordable, different parts, really components of the American dream that many people were sold and still want to believe in are just becoming out of reach. And I think there is a certain resiliency in Gen Z, whereas there are definitely people who want to get rich quick. I guess maybe it's the optimist in me too, where there is a certain resiliency I've seen in many people, and I've seen many people on the other extreme as well, where people kind of feel very hopeless about the situation. Yeah. I've also seen a good amount of people who feel very resilient about, I'm going to do all that I can to reach as far as I can to achieve this. And I'm also going to hope the housing market's going to crash.
Yeah. Well, can't have our cake and eat it too, but we can all hope for it all. But John, thank you for coming on and doing this. Thank you for all your work you've been doing at Great Capital. We're looking forward to a lot more awesome work. And again, this new model is exciting. Looking forward to see how new iterations as you continue to test it, tweak it, improve it. If you want to follow along though, for these types of reports, future reports, make sure you're subscribed to the Great Capital YouTube channel, but also greatcapitalllc.com is where we are going to be posting these research reports that John, Matt, Bosnagel, and the rest of the team are going to be working on. So again, thanks again. This is awesome work. And
glad to be on.
Here. Awesome.